Yesterday afternoon at the White House, Donald Trump did something that sent shockwaves through financial markets, that changed betting odds instantly, and that revealed more about his economic strategy than anything he has said in months. And most people who saw the headlines completely missed what actually happened. They saw Trump hinting at his Federal Reserve chair pick. They saw Kevin Hassett's name mentioned. They saw market reactions. But what they didn't see, what they couldn't see without understanding how the Federal Reserve actually works and what this appointment really means, is that Trump just fundamentally changed the trajectory of American monetary policy for the next decade. And by the time I am done explaining this, you'll understand why financial analysts are calling this the most consequential personnel decision of his second term, why your mortgage rates and car loans and savings accounts are about to look very different, and why Jerome Powell's legacy just got rewritten in real time. Let me walk you through exactly what happened, because the details matter enormously, and the context is everything. Trump was at a cabinet meeting Tuesday afternoon, and he said something that initially seemed routine. He told reporters he'd announce his Federal Reserve chair selection in early 2026. Normal political timeline. Nothing shocking there. But then hours later at a White House event, celebrating something called Trump accounts. These government-funded savings accounts for newborns. He did something politicians almost never do. He essentially revealed his choice before the official announcement. He looked around the room during his remarks and said, "I guess a potential Fed chair is here too. I don't know. Are we allowed to say that?" And then he added, "Thank you, Kevin," directly naming Kevin Hassett, his National Economic Council director and top economic advisor. Now you might think that is just Trump being Trump, casually dropping hints, thinking out loud in public. But I've watched enough of his communication patterns to know that nothing he says publicly is actually casual. Every word is calculated, every hint is deliberate, every seemingly offhand comment serves a strategic purpose. The moment those words left his mouth, prediction markets exploded. On Kalshi, Hassett's odds of getting the job jumped from 66% to 83% in a matter of hours. Polymarket showed the same dramatic shift. The 10-year Treasury yield briefly dropped below 4%. Financial analysts started frantically rewriting their 2026 economic forecasts, because what Trump just signaled wasn't just a personnel change. He signaled a fundamental shift in how America's central bank will operate, what its priorities will be, and how aggressively it will cut interest rates over the next several years. And that shift has massive implications for every American. Whether you are a senior on a fixed income, watching your savings account returns, a young family trying to afford a mortgage, or a business owner making decisions about expansion and hiring. The Federal Reserve doesn't just set abstract policy. It determines the cost of money throughout the entire economy. And Trump just told us he is installing someone who sees eye to eye with him on making that money cheaper, faster, regardless of what traditional central banking orthodoxy might say. Kevin Hassett isn't a random choice or a political crony getting rewarded with a prestigious position. He is an economist who has been in Trump's orbit since the first term, someone who served as chair of the Council of Economic Advisors, someone who has very specific views about monetary policy that align perfectly with what Trump has been demanding for months. And understanding those views is critical to understanding what comes next. Hassett has been publicly arguing that interest rates could be a lot lower than where Jerome Powell has kept them. He supported a 50 basis point rate cut in December, which is double what the Fed typically moves in a single meeting. He has been vocal about his belief that the Fed has been too cautious, too slow, too concerned with fighting inflation that he argues is already under control. And crucially, when asked directly if he'd accept the Fed chair role if offered, he said yes, without hesitation. That is not typical Washington behavior, where everyone pretends they're not interested in powerful positions until they're formally nominated. Hassett wants this job. He is ready for it, and he is already aligned with the president on the fundamental question of where rates should go. Now compare that to Jerome Powell, the current chair whose term ends in May. Powell has been methodical, cautious, data-dependent, in ways that drove Trump absolutely crazy. Trump publicly criticized him dozens of times, gave him the nickname Too Late Powell, argued constantly that the Fed was moving too slowly on rate cuts, and was hurting the economy through excessive caution. The tension between them became one of the defining features of Trump's first term and has continued into the second. Powell represents traditional central banking philosophy. The idea that the Fed should be independent from political pressure, that it should move carefully based on economic data rather than presidential preferences, that fighting inflation is the primary mandate, even if that means accepting some economic pain in the short term. Trump fundamentally rejects that entire framework. He sees the Fed as a tool for economic growth, for making borrowing cheaper, for stimulating activity. And he wants someone running it who shares that vision without apology. But here is where it gets interesting from a systems perspective. The other candidates Trump was reportedly considering, people like Fed Governor Christopher Waller or Michelle Bowman or former Fed Governor Kevin Hassett, they're all credible economists with central banking experience. Waller in particular has been dovish on rates, meaning he favors cutting them aggressively. He was actually the first Fed official to call for lower rates after the June meeting. Bowman has penciled in 3 rate cuts for the year and talks about increasing fragility in the job market. Any of them would have been defensible choices that markets could accept. But Trump is signaling Hassett, someone from outside the Fed system, someone without that institutional background, someone whose primary qualification is loyalty to Trump's economic vision. And that choice tells you everything about what Trump values most. He is not looking for the most qualified central banker. He is looking for someone who will execute his economic strategy without the institutional resistance that Powell represented. He wants someone who will cut rates aggressively, who will prioritize growth over inflation concerns, who will make monetary policy an extension of his broader economic agenda, rather than an independent check on it. Now let me explain what this actually means for how the Federal Reserve functions, because most people don't understand the mechanics of central banking and why this appointment is so consequential. The Fed chair doesn't have dictatorial power. They can't just unilaterally set interest rates or make policy by fiat. They lead a committee, the Federal Open Market Committee, that votes on rate decisions. That committee includes other Fed governors, regional Fed bank presidents, people with their own views, and institutional loyalties. So even if Hassett becomes chair, he'll need to build consensus to persuade other committee members to navigate complex institutional dynamics. But here's the thing about leadership roles in any organization. And I know this from running companies. The chair sets the tone. The chair frames the questions. The chair determines what issues get prioritized and what data gets emphasized. A dovish chair who comes in arguing that rates need to come down fast will shift the entire conversation, will make other committee members who might have been cautious feel more comfortable being aggressive, will create momentum toward cuts that might not have existed under different leadership. And there is another dimension to this that is even more important. If Hassett is coming from outside the Fed system, he'll be appointed not just as chair but also as a Fed governor, with a 14-year term starting in February. That is months before Powell's term, as chair officially ends in May. So you'll have this interesting transition period where Hassett is already on the committee, already participating in discussions, already influencing decisions, even before he formally takes over. And that overlap creates opportunity for Trump to start reshaping Fed policy immediately, not waiting until May when Powell's term ends. Think about that timeline from a strategic perspective. By February, Hassett is on the inside. By May, he is running the institution. By summer, he has had time to build relationships with other committee members, to start shifting the culture, to demonstrate what the new approach looks like. By the end of 2026, the Fed could be operating very differently than it did under Powell, with a much more aggressive stance on rate cuts, much less concern about inflation risks, much more focus on growth and employment. Now, some economists are worried about exactly that scenario. They argue that central bank independence exists for a reason, that political pressure on monetary policy historically leads to bad outcomes, that if you prioritize short-term growth over long-term stability, you end up with inflation spirals and economic volatility. They point to examples from other countries where central banks became tools of political leaders and created economic chaos. They worry that Hassett won't have the institutional credibility or the independents to push back if Trump demands cuts that aren't economically justified. And those concerns aren't crazy. There is real risk in having a Fed chair who is seen as too close to the president, too willing to subordinate monetary policy to political goals. Markets value Fed independence because it provides stability and predictability. If investors start thinking the Fed is just doing whatever the president wants regardless of economic conditions, that creates uncertainty that could actually push rates higher, not lower, as investors demand a risk premium for political interference. So let's talk about what this actually means for ordinary Americans trying to understand how this affects their lives. Because monetary policy sounds abstract until you realize it determines the cost of almost everything you borrow or save. If Hassett becomes Fed chair and does what Trump clearly wants him to do, meaning cutting rates aggressively and keeping them low, here's what happens in practical terms. Mortgage rates come down. If you are trying to buy a house or refinance, that becomes cheaper. A 30-year fixed mortgage that might cost you 6% today could drop to 5% or lower, saving you hundreds per month. Car loans get cheaper. If you are financing a vehicle, the interest rate you pay goes down, making that monthly payment more affordable. Credit card rates, which are usually tied to the Fed's benchmark rate, would eventually come down too, though banks are slower to lower those than they are to raise them. For borrowers, for anyone carrying debt, lower rates are generally good news, because it makes that debt less expensive to service. But there is a flip side that affects a different group of Americans, particularly seniors, living on fixed incomes. When the Fed cuts rates aggressively, the returns you get on savings accounts, on certificates of deposit, on money market funds, all of that comes down too. If you are someone who worked your whole life, saved responsibly, and is now living off the interest from those savings, aggressive rate cuts directly reduce your income. A savings account that was paying you 4.5% might drop to 3% or lower. That is a significant hit to your monthly cash flow if you are depending on that interest to supplement Social Security or a pension. So Trump's push for lower rates helps some Americans, particularly younger people buying homes or carrying student loans. But it hurts other Americans, particularly retirees, who are savers rather than borrowers. And that trade-off is at the heart of why monetary policy is always contentious, always involves winners and losers, always requires difficult judgments about who benefits and who pays the cost. There is also the broader economic question of whether cutting rates aggressively, right now, is even the right move. Inflation has come down significantly from its peak, but it is still above the Fed's 2% target. The labor market is strong, unemployment is low, wages are growing. In that environment, traditional central banking logic says you should be cautious about cutting too fast because you might reignite inflation. If borrowing becomes too cheap, if consumers and businesses suddenly have access to lots of easy money, demand can outstrip supply and prices start rising again. And if that happens, if inflation comes roaring back because the Fed cut too aggressively, then they have to reverse course, raise rates again, potentially causing a recession. That boom, bust cycle is exactly what central bank independence is supposed to prevent. The Fed is supposed to be the adult in the room, making unpopular decisions to maintain long-term stability, even when politicians want short-term stimulus. But Trump's entire economic philosophy rejects that framing. He believes growth is the priority, that low rates stimulate growth, that concerns about inflation are overblown, and that the Fed has been too timid for too long. So here is where we are, and why this matters more than most personnel decisions. Trump has essentially revealed his choice for the most powerful economic position outside of his own cabinet. He is signaling that Kevin Hassett, someone who shares his views on aggressive rate cuts and economic stimulus, will take over the Federal Reserve by summer. Financial markets are already repricing expectations based on that assumption. Prediction markets show over 80% probability that Hassett gets the job. Treasury yields are moving in anticipation of a more dovish Fed, and the implications of that shift will ripple through the economy for years, affecting everything from mortgage rates to inflation to how businesses make investment decisions. This isn't just about one appointment. This is about the fundamental direction of American monetary policy, and whether the Fed maintains its traditional independence or becomes more aligned with presidential priorities. Now, Trump still needs Senate confirmation for his nominee, and that process will be revealing. Senators will ask Hassett about his views on inflation, on central bank independence, on whether he can say no to the president if economic conditions warrant it. His answers will matter. If he comes across as too much of a Trump loyalist, too dismissive of inflation risks, too cavalier about the traditional role of the Fed, he might face tougher questioning than expected. But Republicans control the Senate, and it is hard to imagine them blocking Trump's pick for such an important position unless something truly disqualifying emerges. So the smart money is betting that Hassett gets confirmed, takes over as chair by summer, and immediately begins pushing for the rate cuts that Trump has been demanding for months. Whether that turns out to be brilliant economic policy or a mistake that creates problems down the road, we won't know for a couple of years. But the direction is now clear. For you personally, here is what I'd be thinking about. If you are carrying debt, if you are planning to buy a house or a car, if you are a borrower, this is probably good news for you. Rates are likely headed lower faster than they would have been under a more traditional Fed chair. If you are a saver, if you are retired and living off fixed income, if your financial plan depends on getting reasonable returns from safe investments, start thinking about whether your strategy needs to adjust. And regardless of which category you are in, pay attention to inflation data over the next year. Because if Trump gets his way on aggressive rate cuts and inflation starts creeping back up, that affects everyone through higher prices on everything from groceries to gas to housing. If you found this breakdown helpful and you want to understand what happens as this story unfolds, as Hassett goes through confirmation, as the Fed starts cutting rates under new leadership, hit that subscribe button. Drop a comment with your honest take. Do you think Trump's choice is smart economics or political interference? Are lower rates what America needs right now, or are we risking inflation problems? Your perspective matters, because this affects all of us. Stay informed, think critically, and let's see what happens when Trump's vision for the economy meets the reality of running the world's most important central bank.